Good evening and welcome back to the FiTT Show. Financial information for today and tomorrow. I'm Bobby P. Kinzer,
And I'm Thomas Doty.
and we are the FiTT Show, helping our folks get their finances in shape. Good seeing you, Dote. How's everything going, sir, Governor?
Hanging in, taking it day by day, my brother.
We've been gone a few weeks, you all. This is the summertime schedule that we on, so we take a little hiatus to take care of business. So bear with us, but we're here. We're back going strong, and I must tell you, we will not be here next week because I will be somewhere deep into the islands with no access.
Nice to have money, ain't it?
Oh man, thank God for money. Money isn't everything, so it's better, but it's better than not any. Though speaking about that, right? I saw this thing and it said, "What is the greatest value in life?" And a lot of people say money. Money is not even in the top five. Isn't that interesting?
No, it's true. You think it is, but it's really not.
Yeah, they say because if you were given $1 million, but you'd have to die tomorrow, which one would you take? you know, if you were given $1 million, but you had to be sick for the rest of your life, which one you take? So health is important. It was an interesting survey they did. It said if you were given $1 million, but your mother or wife or partner would have to be sick for the rest of their life, which would you take? So relationships. So money isn't even up there. But I tell you what, it sure makes the world go round. So, so let's talk a little bit, you all about some administrative things. Please click on the like button and the heart, and hit as many times as you can because it counts as multiple times. It doesn't count as one time. They don't look at it that it's coming from you, even if you put it in there 50, 100 times. But how the algorithms work, it helps us reach more people. And please then go out there and put information in the comment box. That one is even greater return because it's greater algorithm. So if you have any comments or you have any ideas or you have some shows you'd like for us to check out, put it in the comment box. Or you just want to say hello, put it in the comment box because it helps us with traction to reach people. That's how it works out here on the social media world. So we appreciate it if you do that. And we just have to get this disclosure. We're not fiduciaries, all right? We're not qualified advisors where you have a fiduciary responsibility. So we will not be telling you any specific things to do with your money, but we will give you general ideas, a basic understanding on different topics, but we will not be giving individual information because we know, hey, it's like a suit. Everybody's suit is cut differently. Everybody's portfolio, everybody's risk tolerance and goals are different. But you can use the information that we give you. And if you do want specific information, please seek advice from a qualified financial advisor, or we end up getting information from our friends that are qualified. You know what I mean? We just don't say go to Uncle Leroy who's in the backyard selling get rich quick schemes, but seek advice, you all. That's something that I think as a culture we don't do that enough, and I'm sure everybody knows why we don't. There's so many reasons I can name, but that's no reason.
And Bob, the biggest reason is to your point that you made a minute ago, is that everybody's situation is different. And if you got a professional financial advisor to help you, you're gonna have to tell him everything that you have, everything you're trying to do, what your goals are, what your risk tolerance are. So there's no way we could even be in a position to give that straightforward advice that would fit your particular situation. What we're trying to do is give financial literacy, give you information so you can make better decisions. That's the difference, I believe.
Right. And remember, there's financial information and there's financial education. Financial information is just that. It's a list of news and a list of information. financial education is where you use critical thinking. We hope that you will take this and apply it appropriately, because there's a lot of misinformation out there these days. Out there, and there's so much that you need to make sure that you research. We can't talk about that enough. Make sure you do your research, and if you hear something out there, try to get a second opinion, just like a doctor, or a third opinion, just to make sure that that information is correct. And one other little tip before we get into the show about financial advisors, qualified financial advisors, or people who are saying they're financial advisors. If they start off telling you, without asking you any question, investments that you can get into, that is the first sign of a not good financial advisor. Because the first thing a good financial advisor should ask you, what is your goal? What are you trying to do? What is your risk tolerance? What is your time horizon? And if they don't ask you that first, just tell them thank you very much, because it's about what you, not what they did. Sometimes they're churning what they call commission. So be aware out there. So, Dope, welcome back. We back here. It's a good thing. We kicking off this July 16th. Make sure you got the right show, because I had people out there thought they were today's show and they weren't. We got a lot of people out there right now, and so great to see everybody out there and people around the world from Scotland. So welcome. It's really early in the morning over there for you all. I said about 1 in the morning, Dope. So thank you for being on. Dope. So is it 3 weeks, Dope? 3 weeks ago now? This would be
3 weeks. When you show the chart, it's back against 3 weeks, and a few things have happened since then. And is it working today, Bob?
We will see in a minute.
There you go. You got it going. You on the street, my brother.
Business, babe.
And I'm gonna tell you, this is we don't usually try to give personal opinions, but the market has been doing pretty well the last couple of weeks, and there's been positive news about inflation. There's been positive news about the job reports, and I'm going to be honest with you. I don't believe the numbers coming out of Washington. I mean, if you've been shopping, I haven't noticed anything slowing down in regards to inflation. That includes gas. I think I was up in Cleveland. I paid $5.79 for a gallon of premium gas. So I'm not sure how inflation is slowing down, but the market is reflecting that. If you look at the S&P, again, this is from 3 weeks ago, so it's not from last week. So in 3 weeks, the S&P is up 2.4%, NASDAQ's up 2%. Microsoft had a big jump. They're up 13%, Apple even more at 21%. NVIDIA's up 5%, and that's given that NVIDIA dropped like 5 points today. So that's still a pretty healthy increase. Google's up, but Google had a big drop today also. Pfizer's pretty much staying flat, as is Boston Scientific. And you can see this is one of the few weeks, Bob, where every single thing I hold is up versus the last period. So I'm definitely happy about that. I'm just not optimistic as we go forward with this war that doesn't look like it's ever going to end. With inflation, I think mortgage rates hit the highest level in a long time today. And again, I don't really see inflation. I haven't noticed it in my everyday purchases. So I think you would think you'd notice something for them to put out information that says that there's been a slowdown in inflation. I haven't seen it, so I am still extremely cautious. Just call me Doubting Thomas.
And you have every reason to be doubting, Dope. So just want to tell you on these numbers, remember this is comparing this week's to 3 weeks ago. And this is a good way to look at it differently, because normally we're doing the week before close today compared to the week before. But this is pretty interesting, just seeing a different look at it, though. And the NASDAQ, man, wow, that was up pretty good. No, can you believe gold is down? It's down almost over $600, man. It's down.
It's been on a tailspin again. Not sure why. It's still way up. I mean, that's the thing. It's still up from its low, but it's went up even more and it's come down some.
Yeah, and for the life of me, I don't know why. you know, but it's down to 3,984 an ounce. And I mean, it was up as high as $5,000 at the beginning of the year. And silver was up over $100 first time ever. It's down to $56 though. And I've been following platinum too, right? Platinum 5 years ago was $800. It's now $1,600, up to over $1,600. And the reason why I say it, I'm starting to follow platinum because silver and platinum it makes up a large portion of what's in data centers that run semiconductors. So I'm keeping an eye on those particular commodities because if they talk about those data centers really building and blowing up all over the place, and they're going to be with silver and platinum, I don't know, it might be worth looking in on it. But just
Yes, it's a lot of the reason it's going up because everybody's expecting interest rates to stay high, and if interest rates stay high, you do better in other investments than gold, right?
right,
Yeah,
correct.
that's one reason. And then the strong U.S. dollar isn't helping because it's more expensive for foreign buyers.
Right.
And finally, with T-yields going up, which they have, I just talked about mortgage rate, but that's another option to invest your money. And finally, like I said, it's going up so much that a lot of people are just taking profits, and ain't nothing ever wrong. Ain't nothing ever wrong with taking a little bit and putting it in the bank and being happy with that.
Just make sure you pay your taxes on it, your capital gains taxes.
It was up as high as 5301. Go, that's
what was?
Go.
Ooh, wow.
Yeah,
and that was the highest ever, though.
That was January 29th.
Yep. Oh, that was January. Wow.
Yeah, and
that's solely how. That's why we talk about diversification, everyone. Because even when something's down, when something's up, something's down. But then when something's down, something's up.
Yeah, but again, looking at a year ago, it was 3,300, and now it's 3,900. So that's still about a 20%
wow
bump.
Wow. Follow that. So dope. Talking about that, and follow this. Cryptocurrency. Cryptocurrency is up like a mug. It's up 70%. The total market cap, that's up $140 billion.
Yeah, tell me why that's going up. And who the heck knows?
Who the heck knows? Look, it's now the Bitcoin is up 7%. It's at $63,781, which is $4,361 up from 3 weeks ago. Go figure.
Wow.
Look at Ethereum, the smart contracts, right? Yeah. Up $300. That's 19%. What's going on with that, though?
Wish I'd have bought some.
Me too. And that's the smart contract ones, right? And then you got Tether, which is the stable coins, but they get ready to start what's the word though? Regulating.
Mm-hmm.
And USDC, which is once again a stable coin. When we say stable coin, is pegged to the dollar. And then you have Ripple, which it used to be up around about the 4th position. It is way down to the 6th position now. And Binance has been holding in there. But cryptocurrency's up, though. No one knows what drives it. That's why it's so highly speculative.
Yeah.
So let's go and get into our show today, though, which is, well, let me tell you what it was when we left 3 weeks ago. We did a mid-year checkup. We hope y'all followed up on that, on some of the things you need to look at for the mid-year. Don't wait until the end of the year. Kind of late then, right? That's why we try to do a mid-year checkup so you can make some adjustments for the end of the year. But today, a simple strategy for average investors. What does that mean, though?
Well, Warren Buffett, who we strongly believe in, he has a simple strategy for investing, and it's called the 90-10 rule. And it urges everyday investors to keep 90% of their investable or savable money in a low-cost S&P index fund, and then put the remainder in short-term instruments, government bonds, something that's guaranteed. And you look at that and you go, wow, that would be pretty risky. And realize when we talk about the average investor, we're talking about someone who's younger, not close to retirement, and they have this money sitting here that they can put away and leave for the long term. Okay, so make sure you understand that. And the idea is simple. Most people don't have the expertise to make great investment decisions, as far as analyzing stocks and determining when to get in, when to get out. And this kind of just makes it simple. And so don't say, well, I'm stupid because I don't know that. Most people don't know how to pick stocks. So you're not unusual, but this takes the guesswork out of it. You're not paying a lot in fees, and you're pretty much betting on the American economy, and you're just being patient. But is this a good strategy for everybody? That's what we're going to talk about. And maybe you decide this is something you can do or something you might consider.
And I know some of you all have heard the term index funds, right? And the whole thing about index funds and ETFs, exchange traded funds, they like index funds are pegged to an index, which makes pretty much sense. And that's why they are what they call passively managed, as opposed to an actively managed fund like a Vanguard Growth Fund, which they actually charge higher fees. So we're going to get into that so you can understand, the particulars about why he's suggesting an index fund at 90% and government bonds at 10%.
Right. Well, just basically money market. We can call it.
Basically money market, yeah, which is one of the lowest risk investments.
Right.
So, Dope, why don't you get us into this conversation?
And it's, again, make sure you understand this isn't for everybody, okay? And this whole thing kind of came about back in 2013 when he sent a letter to his investors. And he is a value investor, okay? And the way Warren Buffett puts it, investing is buying small portions of businesses. And the average investors can't analyze a company that way. The average person we're talking about, they don't have the information to really make a sound decisions. And so if you're one of those non-professionals, the typical investor, you don't have to have that skill. In aggregate, American business has done a wonderful job, over time, and will continue to do so, assuming everything goes as it's planned. And so the typical investors, why would you pay a fund manager? Because in most cases, fund managers don't do better than the S&P. In most cases, very few fund managers actually beat the S&P. So, which is kind of surprising. And just kind of maybe rest for a minute. If anybody asks, why would I use a fund investor? Well, I do because there's other things that comes along with that, as far as overall planning, understanding your risk tolerance, being on top of things. And in my case, that's important to me. But if you look at most, as I said, most fund investors don't beat the S&P. And so Buffett is saying, why should you pay for that when you can just put your money in the S&P? And so he's advising people, don't chase individual stocks. Everybody can tell you the one great stock. Like if you ever talk to me, I'm gonna brag about NVIDIA now. I bought it at 17 and now it's over 200 and I'm happy. But I've also bought some that have gone down. Now, overall, I've done real well, but in this market, most people have done well. And so what he's saying is get away from trying to pick that individual stock and get a spread your risk, and spread your risk and not worry about the little ups and downs. And it's funny. One of the comments he talked about is a bull market. He said it's like sex. It feels best just before it ends. that,
That's a hell of an analogy.
but it's true. It's
It's true.
definitely true because everybody, right when it's rolling, everybody feels great. And so he advised his trustees to invest the cash that he planned to leave to his wife the same way. Put 90% in a very low cost fund, index fund, and 10% in short term investments, And he thinks the long term results for that policy will be superior to anything most investors do, whether it's pension funds, institutions, or individuals who employ high fee managers.
401k plans, 403b plans. It's so interesting, though, this concept, because, and I just want to clarify once again, though, what index funds are. We talked about it before, and this, he's saying the S&P 500. Why you think? Why is he? Because the index means that you just index it to a particular industry or particular market, and then you just follow that. And that's what it's called passive management, because you don't need no big management firm when you just follow what that market is. And we're going to show you in a minute what the S&P has done. But why the S&P 500 as opposed to the NASDAQ, as opposed to the Russell 2000? Why do you think the S&P 500?
Because it's the 500 biggest firms, and it's going to give you, it's going to spread your risk among a bunch of different segments, a bunch of different businesses. And it's diversification at its best. And again, in the long term, you're going to have some companies do good, so some companies do bad. But over the long term, most companies do okay. And that S&P is going to steadily rise, as I'll show you in a minute on the chart. But that's why you pick the 500 biggest firms in the U.S., and you roll with those.
Yeah. And so I want to talk about the components of the 9-10 investment strategy. Remember, this is an investment strategy. Like we say, it's not for everybody, but for the people who don't have a lot of experience in technical analysis and fundamental analysis and know how to do the research, there are two basic elements of a 9-10 investment strategy. Invest 90% of your liquid assets in a low-cost S&P 500 index. Warren Buffett, he recommends Vanguard. I recommend Fidelity. Dope probably recommend somebody.
I'm a Fidelity guy.
I'm a Fidelity guy too, but Vanguard is up there too.
It's you like Chevy, you like Ford.
Right.
Exactly the same thing.
But they're good, and the reason why he goes with that, because they have low expense ratios. Because remember, whenever you're invested into a fund, they charge an expense ratio, and that money they charge you, if it's a high fee, that's money that could be going and compounded in your benefit instead of paying going in their pocket. That's why it's so important to have funds that have low expense ratios. Now, Buffett argues that stocks will continue to provide higher returns over the long run than bonds and cash, right? But he says invest the remaining 10% in short-term government bonds, such as U.S. Treasury bills or money markets, right? And this ensures liquidity, right? Your ability to buy or sell with relative ease, right? And while reducing your overall risk in market returns. Now, the idea is to maximize the long-term growth, which is in the broad equities, the stock side, while maintaining a small cash cushion and minimizing, like I talked to you before, management fees that can erode the portfolio's return.
Okay, this is where it gets interesting. Let's talk about the advantages of this. Okay, first thing is you got long-term returns. S&P has provided reliable long-term returns for almost a century. It's about 10% a year before inflation. Can you show the chart, Bob?
Yes, just a minute.
Let's hope you got it going on today.
Yeah. to look at the draw. Let me see. This is a good chart, y'all, to show you over like a 20-year, 20 no,
It's longer than 20 years, like 100 years, I
40
think.
years, isn't it?
No, it's like it goes way back.
No, this chart only goes back to 1985, though.
Okay.
Let me help you there. Okay.
There you go. Yeah, what is this? I can't see the bottom bar. What is it?
1985 to
85. Okay.
That's 40 years.
Yeah, and the thing I want you to notice is these big shocks, because S&P has absorbed huge shocks, even if you go back to 1930. But the important thing is it always does better afterwards. It always recovers. And the most important thing to look at is if you go back to 85, the beginning, and look at 2025 as the end, it's a steady increase in slope. And you look at all these little drops in the market that happened from Black Monday to the Gulf War, the financial crisis, the Iraq War. You can see what the market
the dot-com bubble in 2000?
Yeah, right. The market takes a hit, but then immediately recovers. Global financial crisis in 2007. You got Brexit in 2015. You got the crazy pandemic in 2019. Look at the drops in each of those, but then look how the market recovers. In 2025, you had that bear market. 2022, you had that bear market. But again, look at how it recovered. And so, as I mentioned before, the S&P has returned an average of 10%. And you can take that back to like 1929 and say it's returned that over the long haul. Now, is that a guarantee that it's going to be there? No, it's not. But that's the best indication you have that the S&P is going to return a reasonable 10% every year. And the other important thing about the 90-10, it has limited risk. A 90% allocation to equity might seem, risky or make you nervous, but you got so much diversification that because it's a broad index fund and the quality and size of the companies, that everything is not going to be bad at once. There's going to be some companies doing good, some companies doing bad, and that's going to mitigate an overall big drop. Another important factor is you have low fees. Fees can make a huge difference in your returns. And if you have a full service advisor versus using one of the low cost advisors, Fidelity's low cost, Vanguard's low cost, Schwab's low cost, compared to the old Merrill Lynch's and companies like that, and that really are their fees are just higher, and so you're going to have a lot more money working for you as opposed to that money going in fees. Another important factor is you don't have to spend a lot of time. It doesn't get much simpler than 90-10. You don't have to rebalance. You don't have to spend a lot of time considering different investments. And that should lead to lower stress. So if you don't have a lot of experience, don't have a lot of time, if you struggle to manage the emotional roller coaster of the market going up and going down, this might be for you. As I said, the S&P has had its stomach churning drops. We just went through some of those since 1985, but it always recovers, and it typically recovers doing much better than it was doing before that big drop. And so knowing the market has always moved up over time should give you a sense of well-being that things are going to work out in the long term.
One of the things I want to point out from this chart is notice there's been a lot of dips in there.
Yeah.
If you look at this chart, several dips, but look at it, the recovery. And I think the longest bear market though is maybe 12 months, a little bit over 12 months. And this shows if you look at these little dips, but notice that green line is steadily going up and up. And look at 2020 though. 2020, it dipped a lot. That was during the pandemic. And in March of 2020, the market dropped about, 30, 40%. And we always talk about time in the market, not timing the market. You know, a lot of people panic and jump out and you realize those losses. But right here at 2020, if you look at that line where the pandemic begins, this was the quickest return of a market in history. It returned within a month, the full 40% and more. More reasons why people should be patient. And like I say, it's time in the market, not timing the market. Um, Another thing, though, I want to talk about the 90 20 rule, the 90-20, the 90-10 rule.
Why did I get married? Two. The 80-20 rule.
The 80-20 rule. This I want to compare the 90-10 rule with traditional allocations. Now, some investors and market analysts have questioned the wisdom of this actually 90-10 rule, include whether does it make sense for all investors, particularly those who are close to retirement. You know, an age where most people start dialing back from equity exposure, meaning more risk, and others, you know, have noted that such a high allocation in equities or stocks may not be suitable for any investor who is deeply uncomfortable with volatility. But there's a financial researcher in the School of Business in Barcelona, Spain, decided to put the strategy to the test, though. His name was Javier Estrada, and he wanted to test how such an allocation would work during a 30-year retirement period with an investor withdrawing 4% a year. Now, they always say, you know, when you're retired and you have a 401k plan, that you should, you know, possibly draw out 4%, you know, to keep up, and they recommend that benchmark, right? So I'm sure that's why they're using this. So this guy's point was that retirees need an allocation that carefully balances the risk of the investor overliving the account versus spending so little that their lifestyle suffers, right? And we always talk about that, though. We don't want you, you know, so tight, you know, that you feel like you're living in a shoebox. You know, we believe that you should live on some of your money. And that's what this test this guy is doing with the 90-20 rule, thinking about 30 years, going forward, retiring, and taking out 4%. So the one change he made in the 90-10 rule was the annual withdrawals would be made from stocks if stocks have gone up, which makes sense, and from bonds if bonds have gone down, giving the stocks time to recover. Interesting strategy. You know, using historic data, this gentleman then ran simulations testing the 90-20 rule with a slight tweak versus other allocations. Like Warren Buffett advised proves to be, unsurprisingly, not simple, but also sound. That's what he came out to show that this 90-10 rule actually works if you're looking at historical numbers. And that's because Buffett's 90-10 rule puts your portfolio in the middle ground between the best performing strategy for upside potential, meaning 100% stocks, and the best performing for downside protection, when people recommend doing 60-40 or doing 70-30 in equities.
Yeah, let me try to wrap it up, Bob. His 92 rules is simple, it's low cost, and it follows his long-term belief that the American economy is going to do well over the long haul. And he's always been skeptical of these professional money managers who, again, most of them don't beat the S&P. And so by putting 90% in a low-cost S&P index fund and 10% in short-term funds, you can benefit from historically proven long-term market growth and still have a safe cushion for downturns, okay? But his approach is not for everybody, okay? It's not for all investors. You know, if you're about ready to retire, you may not be able to handle a big drop in the market at the time that you're leaving the workforce. So again, nothing fits everybody. His 90-10
strategy.
Yeah, it definitely does not fit everybody. Right. A person close to retirement won't have the tolerance for any downturns, and they might be happier with a different allocation. But ultimately, his advice lays out a timeless investing principle. is simple, patient, controls costs, doesn't take a lot of time, and it oftentimes outperforms a lot more complex strategies.
And the interesting thing about this dope is you don't have to have no great big investment knowledge because you're relying on the index tied to a particular index that it follows. And the Standard Poor 500 is definitely one that I like that is pegging it too. There's other index funds too, you all. So that's not the only index funds out there. But this is what Warren Buffett is recommending for the 90-10 rule. They don't.
And the other thing is missing, Bob, is global segmentation. You don't have any European stocks. You don't have any Asian stocks. You don't have any South American stocks. And so someone might say, that's even a broader diversification if you have some money in the European stock. So this isn't for everybody, but it may be for some people.
Right. And that's all we just try to provide you other alternatives because we only know what we know, right? There's a question by Garnett Nickens. And Garnett said, can you explain what a 529 account is?
529 account is a way to save for college, for yourself, your kids, your grandkids. And in most cases, it's deductible on your state taxes. And the money can grow, tax-free in that fund. And you can start, if you start when they're young and put it in a 529. And each state has their own little program. So it's by state. And it's just a way to save for college, to get some tax benefit, and let that money grow interest-free. You run into issues if the kid doesn't go to school, but I think most states have made it a little more liberal in that if you don't use the money, there are options as opposed to having to go back and pay taxes on all that money. But it's a way to save for college.
But if you take the money, if you don't use it, your principal stays the same, but you may not get the interest if you don't use it.
Yeah, and again, if you're interested in doing it, make sure you understand all the rules and understand that it varies by state.
And if I'm correct, though, you don't have to be a resident of that state.
No.
But Maryland is managed by T. Rowe Price, and
Okay.
they do a pretty good job. And it's T. Rowe Price. I think it's T. Rowe Price, and they do a good job. And by the way, though, they've changed some of the requirements. Now you can use it for private school. You don't have to use it for college anymore. It used to be just for college, but now you can use it for private schools now.
And also you can use it for like books and other things instead of just tuition, room and board, right?
Anything involving education.
Yeah, which it didn't used to be like that. It was pretty much you had to use it for. Yeah, it's a lot more flexible now.
And I just want to give an example, just an example. Me and my wife, when my daughter was born, we started putting $100 a month. She's 20, get ready to be 23 now. But we stopped just last year. We stopped, but we started with $100 a month. Then as time went on, we bumped it up though to $500 a month. And then when it got close to her graduating out of high school, we bumped it up to $1,000 a month. But way less months, we put $1,000 in it than we did early on. So
even my daughter Taylor, she's in New York City, New York State, where state taxes are very, very high. And she actually is using a 529 for her law school.
Right.
And I think their tax rate might be something like 10%. And that's a pretty considerable amount of money.
Right.
And plus, while it's in there, it grows tax-free. You don't have to pay tax on it when you pull it out. So it can be a very, very valuable asset if you have someone to pay college for. Kids, grandkids, spouses, yourself. it could, especially if you're in a high cost state, a high tax state is what I'm trying to say.
And if you're a grandparent, you can take advantage of it for grandchildren. So, dope, from her birth to 18 years old, 18 years, we put a total of $68,000 in it.
Okay.
It grew to 121,000.
Yeah, you can't, and you don't have to pay tax on that difference either.
Right. So
State tax. I don't think you have to pay federal tax either. I'm not sure on that.
No, it's not triple exempt. It's I think though this you don't pay state tax.
I know you don't pay state tax.
Right. No, you have to pay federal tax.
On the growth?
On the growth. Only on the growth.
Okay, I'm gonna confirm that.
Yeah, check that out for a bit. I'm almost sure it's the growth, but you don't pay it on the state. And it's a great vehicle to supplement your kids and grandkids future education fees. That's yeah. Garnett said, wow, that's decent. Yeah, it's a great tool, and it and dope. I think that T. Rowe Price Fund in Maryland, I think I was growing something like average 8% dope.
Yeah, it says you generally do not pay taxes on the earnings in a 529 plan.
That's it.
Provided the funds are used for qualified education expenses. That's huge.
Huge.
You went from 68 to 120. That's $52,000, and if you pay 30% taxes on that, that's a nice hunk of change. So it that's fantastic. You don't get a tax break on the federal side. You get a tax break on the state side. The earnings, you don't pay tax on the earnings. So that's tremendous.
That's big though. That's big. But so anyway, that's it. On the 90-10 rule from Warren Buffett, who went to my high school though, Woodrow Wilson.
Did he really?
Yeah, in Washington D.C.
Cool.
He went to Woodrow Wilson up in Northwest Uptown D.C. So dope. Let's get into the takeaways of today's message. And look, if y'all have any questions or comments, please put them in that box. We are here to help you out. All right, so I'll start it off, dope.
Okay.
Today's summary and takeaway, y'all. Strategy for the average investor. This is for the person who, is not, investment savvy, doesn't follow the market. Like I said before, you don't do technical analysis. You're not looking at charts. You're not that, don't have that much information. And it is, such a simpler way to let the fund manage it for you. So it's for the average investor, like we say, and you don't have to, like I said, you don't have to have a wealth of knowledge. It's just a basic understanding.
Yeah, and Bob, it's pretty simple and it's effective. You pretty much put all your money in one bucket. It's diversified. It's managed in an index fund. You set it and forget it. Remember that old commercial? You say that, set it and forget it on that,
right.
That oven. And we talked about the history of the S&P and how well it's done. It's a proven, historically proven way to grow your funds over the long haul.
And it's a great way to start investing, because I know a lot of people on this call, I know personally, have money in their 401k plan and they just left it in there in the beginning because they didn't know anything about it. They just left whatever the allocation was. They left it as it was, and they just been letting it grow. But yet they have money in like a checking account, large sums of money. I'm talking about like thousands of dollars in their checking account, thousands of dollars in a traditional savings account. And by the way, there's 5 reasons why if your money is in a savings account, you will stay broke. Inflation, missing out on opportunities, cash flow. There's so many reasons why just having it sitting in a traditional savings account. And this is just another alternative, to get started investing outside of your 401k plan if that's all you had, but you have all this cash sitting around not talking about putting it all in there, but it's another way because there's two things you need to be talking about: protecting your wealth and building your wealth. Because a dollar today is not worth a dollar tomorrow. So this is another great way to start investing. Just another alternative.
Yes, and especially if you aren't saving, it's a good way to start and just put it in an index fund and forget about it. And finally, you got to realize this isn't for everybody. That this won't work for every situation. You got to look at your own situation and see if it fits for you. Again, if you're close to retirement, you don't want to have 90% of your money invested in the market because things happen. They could be political, they could be environmental, they could be medical, they could be a whole lot of things that cause the market to take a dip. And once you reach retirement age, you don't have the time frame. You don't always have a time frame to recover. So it's not for everybody, but it will work for a lot of people. If you're looking for something where you don't have to be involved in picking stocks, you don't have to be involved in doing analysis, you don't have to worry about rebalancing, you don't have to worry about timing, and you don't have time to do any of that, then it may be for you. It may be for you, but you have to gauge that for yourself.
I listened to a retirement specialist the other day, and she had a different twist on things. She's like, I don't see it as a retirement plan. She said, I see it as a wealth building plan. She said, because, our life expectancy used to be a lot shorter. I think it was 68 for men and 70 for women. Now it's 86 for men and 88 for women. So people are living longer and people are taking a little bit more risk early on into what we call retirement because they got a lot more time for their investments to grow, to take a loss, but actually grow. So it's two things, you must consider. You must have a strategy on protecting your wealth, savings accounts, emergency fund, things like that, and building your wealth. And it's basically three things that you must do with your money: earn money, manage your money, and invest money. Earn money, simple. That's a job. You got to work. That's compensation. You got to work. Talent, you can make money off that, but you got to work. Your passion, you can make money off that. A new skill, that's all under earn money. Manage money is plain and simple budgeting and intentional spending and the mastery of credit. And the third one is what we're talking about: investing, man. Investing in building a wealth fund that you can do, travel to places like St. Martin for 7 days in a villa with a cook that cook all your food for the. Why does that sound familiar? So anyway, don't.
When you're missing one, you got to add a fourth in there, and that's protect. That's the fourth one you got to add.
Yes.
It's probably part of managing, but you got to protect your money.
You got to protect. But remember, I said that was in the two first: protect your money and building wealth. Aha! I did get that. So, dope. It would not be a total show if I did not give the Big Bob quote of the day. And this is a deep one, though.
Okay, I'm ready.
Forgive yourself for not knowing earlier what only time could teach. You don't seem impressed.
No, I am.
Do I need to repeat it?
No. That's one I gave to you. So how can I not be impressed?
You don't have to tell everybody. All right, y'all, thank y'all for tuning in. Like I said, next week I'm going to be out of the country and not capable to be able to get online. So hang with us, but we're going to pick it back up. And from after next week, if all the good Lord willing, we will be moving every week from that into the fall and into the winter, into the next year. So until then, thank you very much. And look, happy birthday, Michael Graham. It's Michael Graham's birthday, man. And Mike, he always struggling to get, Bob, I was trying to get on. I tried to get on Facebook. I tried to get on. And I missed it, but he's on today. So thank you for tuning in, Michael Graham. And tune in every Tuesday, the Michael Graham Show. I co-hosted with Michael Graham, and we've had some wonderful, wonderful guests. But remember, we're here every Thursday at 8 p.m. Make sure you tune in. And I was just trying to look for that banner. Make sure you tune in. You all, we're here every Thursday, 8 p.m. Please share on Facebook Live and subscribe and get your friends and families to subscribe to YouTube if they don't do Facebook. There's no excuse. We got a lot more information coming for the rest of the year, you all. So thank you for tuning in and have a wonderful, wonderful rest of the week. Peace be with you. Oh, got a comment. Great information. Okay, great. So we had a comment there. All right, see you all.
Peace.